Hello everyone, welcome to HFI's Year-End Tax Planning Opportunities webinar. This is a semi-annual series that we try to put on financial planning and tax related. We don't practice as CPAs, we practice as financial planners, though Amanda Runkles, who will present, is a CPA as well as a financial planner. Again, we don't actually practice as CPAs. We leave that up to our good friends, the real tax advisors. So today we're going to touch on some of the things that you should be aware of as investors here at the end of the year. There aren't a whole lot of changes, but Amanda will talk about that a little bit. And then as we go, we haven't figured the technology out well enough to accept questions during the presentation. But at the end of the presentation, we'll have our contact information, and you can email us or give us a call, and of course we'll be happy to give you some insight where we can. So again, I'm Rob Hoxton. I'm founder of HFI Wealth Management, and I'm going to turn the headphone over to Amanda Runkles. Amanda joined us almost 4 years ago. She's a CPA and a certified financial planner, and is also senior wealth manager and the director of financial planning here at HFI. So I'll hand it over to Amanda. Here you go.
Thank you, Rob, and hello to everyone, and thank you for taking your lunchtime today to join us to talk about taxes. I know that's pretty much everybody's favorite topic, so I thank you for joining us today. I'm going to go ahead and jump in and tell you that I've got good news and bad news, and interestingly enough, they're the exact same thing. The good news is that there haven't been many changes to the tax code since tax reform in 2013. So the good news is that we know what's coming. We don't have to figure out any new tax laws. What's the bad news is that there haven't been any changes to the tax code since 2013. So that means we know what's coming. We know that higher taxes are coming. We know it's going to be complicated. And so there's good to that and there's bad to that. If you've watched any of my previous webinars, I talked in great detail about the taxes on both of these pieces of legislation, the Affordable Care Act and the American Taxpayer Relief Act. I've gone into great detail about all of these. I'm not going to touch upon all of them in today's webinar. I am going to talk about the more complicated ones, the 3.8% surtax and the PEP and Pease limitations, because unfortunately those will affect more people and they're the most complicated to understand. So like I said, we're going to go through those. But you can see here a list of the taxes from the Affordable Care Act. There's a 0.9% tax on earnings. That's pretty straightforward. It's just a tax that's added on to any earned income that you have. Obviously the 3.8% surtax we're going to talk about. Then the American Taxpayer Relief Act. There were lots of things that came out of that, the first being the PEP and Pease limitations, and again, those are very confusing, and we're going to touch upon that today. There's also a 39.6% marginal tax bracket in place. That's very straightforward. It's just a tax against your income once you reach a certain level. And there's also 20% tax on capital gains and dividends. Again, very straightforward. If your income amount is over a certain amount, you get hit with a 20% tax on those income items. We're not going to talk about those because they're straightforward. Again, we're going to talk about the 3.8% and the PEP and Pease limitations. I do want to point out these important thresholds before we get started. What you can see here, if you're a single taxpayer or if you're married filing jointly, these are the income levels where you're going to get hit with these taxes or these limitations. So you can see here the income levels where you start getting hit with the 0.9% and 3.8% surtaxes, the income levels where you get hit with these PEP and Pease limitations, and then you have the same income level for the 39.6% marginal tax bracket and the 20% capital gain rate. Okay, so let's talk about the 3.8% Medicare surtax. The last few webinars I've done, I've gone into this in great detail, and I've even had some examples to show you how this works. I'm not going to show you any examples today, but I am going to give a refresher on the way that it works. So let's start by defining the terms here. The tax is applied to the lesser of two different buckets. Your first bucket is your net investment income, or it's applied against your modified adjusted gross income less a threshold amount. So if you want to figure out whether these taxes will affect you, you need to figure out these two buckets separately and then determine which is less. So again, net investment income is the first term, and then modified adjusted gross income and the threshold amount is the second term. So let's define net investment income. What it includes: interest, dividends, annuity distributions, rents, royalties, passive activity income, and capital gains. So when you figure out that first bucket, these are the income items that you want to take into consideration. It does not include salaries, IRA distributions, self-employment income, when you sell a partnership or an S-corp, or any other income that's otherwise excluded. So you don't need to worry about these income items. It's only these income items that make up bucket number one. Okay, bucket number two is your modified adjusted gross income. So for most taxpayers, what you're going to do is pull out your prior year tax return, go to the first page, and look at this adjusted gross income number all the way at the bottom. That is, again, the number most of you will use. Now, if you have foreign earned income, you'll have to add that back. And those two numbers added together are what's called modified adjusted gross income. But if you don't have foreign earned income, or if it's not significant, just use your adjusted gross income number, and that'll work fine for determining whether you're going to be hit with this tax. So figure out your adjusted gross income number, and then you want to look at the threshold amount. So again, this is the amount of income that the tax is not applied to. So you're going to take $200,000 for single taxpayers, $250,000 for married taxpayers filing jointly. So again, your net investment income, bucket number one, interest, dividends, capital gains, rents, royalties, etc., versus your AGI minus that threshold amount. Whichever one is less, you're going to apply the 3.8% to. So if your income is less than $200,000 or $250,000, depending on your filing status, you don't have to worry about this at all. But if your income is in excess of that, you're going to get hit with this tax. It's just a matter of to what extent. So that's the 3.8% surtax. So we're going to talk about the phase outs for personal exemptions and itemized deductions. Excuse me for 1 second. I think we're having a little bit of technical difficulty. I'm gonna continue, and hopefully we can get that worked out. I'm sorry about that. For the personal exemptions, these are things that all taxpayers are basically entitled to. So every person in your household is technically allowed to have a personal exemption. But until the American Taxpayer Relief Act came into play, that was the case. But once the American Taxpayer Relief came into effect, the government said, oh wait, no, if you have income above a certain amount, you're not going to be able to take all of your personal exemptions anymore. So for every 2%, for every $2,500 your income is above the threshold, you have to reduce your personal exemption by 2%. This can be fully phased out. If your income is above these amounts, then that exemption will be completely phased out. Now, itemized deductions are totally different. So your personal exemptions are one thing, and then if you understand taxes, you can either take a standard deduction or a bucket of itemized deductions, whichever is more. And so itemized deductions are things like your mortgage interest, your taxes you pay for real estate, charitable contributions. So again, the government said if you make more than this amount of money, we're not going to let you take the full amount of itemized deduction. It can only be reduced up to 80%. So at a minimum, you will still be able to take 20% of your deduction. But again, it's phased out for every 3% your income is above AGI. So now that I sort of understand the taxes, how do I plan? So this is new to this presentation. I'm going to talk about forecasting the future and doing a tax projection. This is such a cool and important thing to do. When I say cool, I'm a CPA, so it's cool to me. But a tax projection, what you can do is look at what your income is going to look like for maybe the next 5 to 10 years in the future. There might be significant events that are happening within those 5 or 10 years that you may not have thought about what the tax impact is, but it may subject you to one of these taxes that we've talked about. And so there may be years that you can plan around that. So if you know 3 years from now you're going to have a significant taxable event, you may be able to do something within the next year or two to plan for that. So when you look at your tax projection, this is something really important to do with your CPA or your accountant, and I would absolutely recommend that you do this. Some things that you might want to look for: salary increases, onset of Social Security or pension income, required minimum distributions from your retirement accounts. So once you're 70 and a half, you have to start taking distributions from your retirement accounts. If your retirement accounts are significant in value, then this could certainly be a significant tax item. And then maybe you have a rental property that you want to sell. And of course, that's going to create a tax impact as well. So I created an example that I'm going to go through and show you how important this may be. But first, let's look at, again, this chart, and you'll be able to see what the income levels are and then what the different taxes are. What we're going to do, I actually want to pause for a second and let you know that we're recording this, and we're going to post this webinar to our website. So if this is of interest to you, you might want to watch the replay and pause it at certain times and maybe jot down these numbers, or even email me and I can send you these slides. This is a really important table to look at, and I'm going to have another one later in the presentation that would be really beneficial. Okay, so let's look at this example. This is a married couple, totally fictitious. I made all of this up. But they're a few years from retirement, and they have some things happening in the next few years that will definitely impact their taxes. So they did a tax projection next year. They just have their income coming in, nothing extraordinary there. In 2016, because of the way that their compensation is structured, they're expecting a very large bonus, which will increase their income for that year to $275,000. The following year, they're about to enter retirement. They don't want to mess with their rental property once they're retired, so they want to go ahead and sell that so they don't have to deal with it in retirement. So they sell it. Income increases to $375,000 for that year. The following year, they're retired. Now they have pension. Now they have Social Security. And now they're taking drawdowns from investment accounts, so they have capital gains taxes. The following year, again, they're still retired, and now they're 70 and a half, and they have required minimum distributions to take into consideration. So you can see over a 5-year period how much, how volatile their income numbers are. They're going up and they're going down. In any given year, they're subjected to different tax amounts. So obviously nothing extraordinary in 2015. 2016, they're above that threshold amount, and now they're going to be subjected to the 0.9% and 3.8% surtax. The following year, their income jumps high enough that not only are they subjected to these surtaxes, now they have to worry about the PEP and Pease limitations. In 2018, their income comes back down. They're right on the borderline of maybe or maybe not having these taxes. And then in 2019, with the addition of the RMDs, they have to worry about those taxes again and the PEP and Pease limitations. So in any given year, there's a different tax situation going on. So you might look at this and say, well, what would you do to plan? Well, just one idea in general is, in 2017, they know that their itemized deductions are potentially going to be limited. So they may want to double up on charitable contributions in 2016 and plan to not give as much in 2017 since they won't be able to deduct as much. So those are just some ideas that come out of this projection that are just wonderful and great to kind of forecast and think about what's going to happen in the future. Okay, so now you have your tax projection done. So now what do you do? So now we have an understanding of what the taxes are. You may have an idea of how they'll affect you in the future. So now how can you plan for them? So again, this is another chart that I put together. Has the different taxes here across the top, and then different strategies that you may employ to reduce your tax impact. So this is the other chart that I would recommend that you pause and print out if you're watching the replay, or you can ask me to send you, and I'd be happy to do that. We're going to talk about each one of these strategies a little bit more in detail. If you are interested in reducing your net investment income, if that may be a strategy that helps reduce your taxes, some ideas that you have or may have to do that, rental real estate is actually an increase in net investment income, but what's interesting is that when you have a rental property, you generally have depreciation expense, and the income and depreciation expense oftentimes offset each other so that there's not a big tax impact. Oil and gas investments may be something to do. Charitable planning. So what this does, like, let's assume that you have an asset in your portfolio that generates interest and dividends and capital gains, and you have significant taxes from it every year. If you were planning to contribute that to charity upon your death, you could consider going ahead and doing that now, and then the asset that generates income is actually out of your portfolio, not generating income anymore. So that's a consideration. Capital loss harvesting is something that's really, really interesting. And this could be used in many different ways. You could do capital loss harvesting to reduce taxes in the current year. You can do capital loss harvesting now for future years and bank a loss that you plan to use 3 or 4 years down the road, but you may not know that unless you do your tax projection. So what capital loss harvesting is a process in which you have an investment asset that has a significant loss associated with it. You're actually allowed to sell it and capture the loss and use the loss to offset your income. Now there's lots of rules that you have to be careful of. The IRS doesn't let you sell it at a loss and then buy it again the next day. It's called the wash sale rule, and they won't let you do that. So you definitely want to do some planning involved in that strategy, but it's a great strategy to use if it makes sense for you. Municipal bonds generate tax-free income, and in some situations annuities may make sense. Okay, so if you want to reduce your adjusted gross income, you can increase contributions to your retirement accounts or IRAs. These next 3 ideas are actually ideas that could help in the future. So again, these support the tax projection. Increasing contributions to Roth IRAs actually doesn't reduce your adjusted gross income in the year that you do it. It reduces your adjusted gross income in the year you take distributions from it. So again, planning ahead. You may know that a few years from now you've got significant income, and if you want to take money out tax-free, you do it from a Roth. So you go ahead and start putting money in Roth IRAs, now planning ahead for that. The same thing with Roth IRA conversions. It's a tool for the future. Again, capital loss harvesting we have talked about, and tax-exempt bonds, so getting tax-free income is great as well. So I want to point out that this last idea, the RMD directly to charity, this was something that you could do through the end of 2013. So before 2014, what you could do is direct your required minimum distribution to go directly to a charity. It doesn't ever come to you, it just goes directly to a charity. What that accomplishes is exempting that income from being taxed at all. So it's completely excluded from being an income item on your tax return. But what's interesting is that it expired at the end of 2013, so it's not actually in place for 2014 as of today. Now there's some legislation in Congress right now that actually may make that permanent going forward, but as of today that hasn't been approved. At this point it's probably too late to plan for that for 2014, but depending on what Congress does, that may be something that's allowed again down the road. Okay, if you want to increase your above-the-line deductions, again, you can contribute to retirement accounts. I put in the contribution limits for 2014 and for 2015. You'll notice 2 different amounts. The first is for those employees that are under age 50, and if you're above age 50, you can actually contribute more. You can maximize your IRA contributions. Those limits didn't change from 2014 to 2015. You may also want to contribute to HSA accounts. If you plan to reduce itemized deductions, one idea, you may refinance or pay down your mortgage, which will actually reduce the amount of interest that you pay and therefore reduce the amount of interest you claim on your tax return. Contributing to a 529 college savings account reduces your state taxes, and your state taxes are actually a deduction on your federal income tax return. So if you're able to reduce your state taxes, there'll be less to deduct on your federal return. If you want to increase your itemized deductions, you could give more to charity, or actually you can, there's a certain rule in place for those individuals that are older than 65. The law changed a few years ago. The threshold for deducting medical expenses, I think, is about 10%. So the expenses have to exceed 10% of your income before you can deduct them. But there's a window of time over the next 2 years that if you're age 65 or older, the limit's only 7.5%. So it gives you some time to deduct more medical expenses on your tax return. So sometimes it may make sense to plan a medical procedure or front-end load your medical bills during this time period so you can take advantage of a lower threshold. Okay, a few other ideas that are in place. Bracket management, again, this kind of goes hand in hand with that tax projection. If you know what your income level is projected to be, and you know you have wiggle room before you move up to the next tax bracket, you may want to take more income in that bracket to be taxed at a lower rate than you possibly may be in the future. If you fall in the lower two marginal tax brackets, your capital gain tax is actually 0. So if you're not expecting a lot of income in a year, maybe you want to do some gain harvesting. Take your gains when you know they won't be taxed at anything. Get a step up in basis for the future. Gain harvesting, again, we just talked about. So you know you're going to be taxed potentially at a higher rate in the future. So maybe you want to go ahead and sell some assets now, capitalize on a lower tax impact, and get a step up in basis for down the road. Capital loss harvesting, we've already discussed. And then giving income producing assets outside of your household. Again, so if you have a income producing asset that you planned to leave in your estate, but it's creating a tax headache for you, you can actually potentially give that away to a member of your family. Maybe that member in your family is being taxed at a lower rate, so you can get it out of your tax umbrella, get it into their tax umbrella, and it's off the books. And you can actually give $14,000 each year per person, or if you split it with your spouse, you can actually give $28,000 a year per person. Okay, so we still have 19 days left in 2014, so there's definitely still some things that you can do in the next 19 days to help your tax reduce your tax impact. You can do capital gain and loss harvesting before the end of the year. You can still make contributions to charities. You can still open and fund 529 college savings accounts. You can front-end load any medical bills that you may have. Go ahead and pay them in 2014. Or you still have time to give income-producing assets to members outside of your tax umbrella. Remember, as of today, you cannot give your RMD directly to a charity. That might be different tomorrow, but as of today, that's not in place. And then you have until April of 2015 to make 2014 IRA contributions. Okay, so that's going to wrap it up for today. I know that's a lot of information. I've provided my contact information here from you, and I'd love to hear from you. If you have questions, feel free to email or call me. Thank you for taking a little bit of time from your lunch to meet with me today, and I'm going to turn it back over to Rob.
Thanks, Amanda. It's really, to listen to you, it's obvious that you enjoy what you do, and this information, for me, is just another reminder of how important a relationship with a great tax advisor is. So if you're listening, and I have to say the turnout today is fantastic, I would suggest that you get in touch with your CPA if you have some issues or some opportunities that you think. Call us if you want clarification. I will tell you that for those of you who are current HFI clients, we work very closely with your tax advisors. Usually in mid-November we send some tax projections or some income and capital gains projections to CPAs, and then we, for you, engage in gain and loss harvesting to try to minimize taxes. So it's great to have a coordinated team working on your behalf. So, but again, we're not tax preparers, and we don't want to be thought of in that role, but we are here to help. So also keep an eye out for an invitation. We'll be having our kickoff webinar, which is specifically just investments, market, and economy related. That'll be at the end of January, beginning of February, so keep an eye out for that. You can see on the screen our locations, our contact information, so please feel free to call us, email us, visit us, and if we don't talk to you, we wish you the very best for the holiday season and look forward to seeing you in the new year.